All right, so here we go. So happy to have you on. We've got Troy Williams, my guest today, and we've worked several deals together. And what I've really found in working with Troy is that he's the Michael Basquate of creative financing. If you give him a problem, he can solve it, and he's a genius when it comes to structuring deals. So that's really what we want to focus on today. By way of introduction, Troy, can you just tell us a little bit about who you are and how you got started in the lending space?
Yeah. Thanks again, Eric, for having me. Um, Name's Troy Williams. I'm a branch manager for Paramount Residential Mortgage Group, or PRMG. Been doing this now going on 15 years. Started out when I was 20, so couldn't even legally drink, which is almost necessary for the real estate space. No, just kidding. But my father's been in this business for a long time. Him and his group kind of mentored me when I got started, and ironically, um, I'll never say this to his face. He works for me now in the best way possible. And then the other gentleman and a couple of his teammates from back in the day, they now come to me for solutions and advice. So it's been kind of this full circle going on. And, I started out so young that my niche in the business was, how do I get deals? I'm 20 years old. I look like a baby, right? And I'm talking with clients, real estate agents, financial advisors, advising on how to buy your first house or your first investment property. And I just had to find this way because age was something that was on my mind forefront. And to get out of that was, let me find the right way to do something, but something that nobody else can do. If you're being told no, how can I make it a yes the right way, within the box, within the lines, without jeopardizing anything, not doing anything fishy, but just working? And so I kind of built my entire business model and I guess reputation and success I've had in this business so far was that. So I do get stuck in a best way possible. I say that my phone rings with clients that need problems solved, and so there are lots of options, lots of scenarios and structures that you can actually go down that most lenders, either one, aren't aware of, because it does take work. And I know that sounds again bad, but that's what we do for our clients. And then two, it's not easy. Everything changes every day in this industry, as you're fully aware, right? The news says something, the media says something, the regulatory parties say another thing, and constantly, week after week, something's changing. And so, the last piece I would say is, yes, we're a full service suite lender. Anything from conventional FHA, VA govies, all the way up into alt doc qualifying, construction bridge loans, ground up construction financing, and my specialty in the non-QM space, which is alternative document qualifying, alternative income document qualifying for my self-employed borrowers, especially in the state of California, where we know how hard it is just to live, right? With the high costs, high expenses. $100,000 salary nowadays is not, unfortunately, not what it used to be, especially out here in California. So, as I'm sure you're aware, Eric, I know a ton of my clients, family, friends, they have side hustles or jobs or hobbies that they maybe have cash income coming in where they can afford things, but on paper to qualify, they can't. And so there's been this disconnect for years of, well, this is a really qualified borrower. I just can't prove it with tax returns. And that's kind of
Mhm.
like the staple, right, in lending of need 2 years tax returns. You got to have the average. Well, what happens to all these other borrowers that are actually just as qualified, if not more qualified, to purchase a house? We just can't document it. And that's where that kind of niche suite of non QM comes into play that I have become, I feel, a master in, just because of that clientele space, especially out here. So it really is still the American dream, how we get somebody in home ownership, whether it's a roof over your head to live. At the end of the day, there's still an investment side to that behind the scenes, right? I mean, it takes a long enough time to save up $100,000 for a down payment. Well, if we want to move into another property or move up into a bigger property because we have a family, now you have a mortgage. How hard is it to save? Well, your house is actually your savings account. It's a frozen, forced savings and investment tool that is kind of spoken on, but it's not really dove into, right? And so, kind of one of the things I do with all my clients is we have that conversation of, yes, this may be your primary residence, but here's what a 2, 5, and 10-year outlook looks like, how we turn that into net worth, into another property or your move up sale or something of the sort. And so we're really looking after everybody from the beginning again, as cliche as this sounds, client for life mentality. That's really how I built my business, and doing those things that I think are vital, right? If I'm going to hand you, Eric, $1 million in debt, that's what I am. I'm a debt provider. My job is to manage it and then show you the best way to leverage it into future assets. And that's really, I think, my little background that I would like to go with. I mean, the last thing I would say too, I'm sorry, is, not egotistical saying, but, I am part of the Scotsman Guide, top 1% in the country. I've worked my tail off to get there, my team, etc. So we know what we're doing. Not everything is easy, as you're fully aware in this business right now. But, when we do have a deal or a client or something of the sort, especially if there's a problem, they always have 110, 150% of our attention. So we take it very seriously.
Yeah, and I can certainly vouch for you and your team in that respect. Before we hopped on and started recording, you were telling me about a client that you helped build a portfolio from 500,000 net worth, and now he's at 13 million. Can you tell us a little bit about that story and how you were instrumental in helping him grow his wealth, and then what we can do that maybe we're at the 500,000 range, what we can do and sort of step it out to be in the multi seven, eight figure net worth in the next 10 years?
Yeah, absolutely. So it was some of my favorite clients. We bought their first house back in 2015. They are self-employed. They're business owners here in Ventura County. Very ambitious. Also immigrants, which was wonderful. So, I do take a lot of pride in that. And we structured it in a fashion where, we want to put as little amount down as possible, but still having that personable, payment comfort in mind. Okay. So we don't want to completely drain our accounts to put maybe 20% down, say, right at the end of the day, and be left with no reserves, nothing in the tank. If you want to do anything to your property, you're going out and leveraging it on credit cards. I just think that's a bad media play that is just pushed into people. Or with that specific client, we went with a 10% down route. We avoided mortgage insurance altogether. Okay, so there's no mortgage insurance, 10% down. They bought the property. It needed a little TLC. It wasn't like a fixer, right, where they necessarily had to gut the place, but little TLC. And our game plan was, okay, within 12 months, how do we leverage this property now into buying an investment property? So sure enough, 12 months later, I think it was actually 9.5 is when we started looking. We had built up another 10 to 15% of equity, right? Just through market appreciation, right? You're paying down your mortgage, you're also paying down a balance, and it's appreciating year over year. So we found another property in the same town, smaller price point. It was like a $350,000 price point at the time. And we ended up putting a HELOC, a home equity line of credit, on the back end of their primary, and use those funds as a down payment on the investment property. And really, that kind of started snowballing it to the degree where within 12 months later, we bought another one of that price point. Well, now you had 3 different properties all appreciating in value. Then an opportunity came up where there's a little more land involved, right? Acreage started coming into play. I'm going to avoid the word hobby farm because they were not farmers. Okay. However, there was some acreage and there were some orchards and stuff on the property. But the point of it, there was room to build an addition or a second unit. And so what happened again, we looked at it, they came up, and now our price points were ticking into the millions. Still with the same mindset of, hey, let's leverage and put down as little as possible where it's comfortable, never overextending. And so we ended up, they purchased another property with a little more land, bigger house where they moved into because they did have a couple kids at that time, right? So their family grew. And we rented out the first house. The other 3 were all rented on long-term rents. We purchased this other property with 10% down. Now we're in the jumbo space, which a lot of people don't realize. Again, 10% down, no mortgage insurance. They kept all their money and their savings and checking account that they've been working and saving for in their bank. We tacked on a different line of credit on one of their rentals to accomplish the down payment for this new house. And that has literally snowballed now over 10 years. We're on Thursday today. So on Tuesday of this week, we just closed on another $3.5 million property. and we didn't spend a dime out of their checking or savings. We leveraged it out of another property that we'd bought. So their portfolio has literally grown from 500,000 to about 13.5 million. And we have not touched a dime out of their personal checking or savings. It's all been leveraged off of different properties and not over leveraged, right? We're not going where, we're now having mortgage payments more than the rent's going to cover. Okay. So there is, financial equations involved, but we just set it up properly where, hey, you're not going to get rich right now today off passive income from those rentals. That's not the goal. We want those tenants to pay down your properties over time while we're leveraging them to buy other assets. Because when you pull cash out of a property, it's non-taxable income. That's where, again, the rich and the wealthy, through, I think it's 78% of millionaires are millionaires through real estate, using these laws and rules and regulations that are set in stone by, regulatory parties, and it's non-taxable income. So their money is still growing in their checking and savings account. They have reserves in there, and we're literally leveraging from one property to another. Once we get to a certain point, I'll fast forward a couple of years, then we fixed up that first property they ever bought. We took the first and second, combined it into one loan. Low payment, right? The rent's now passive, it's covering, and some cash flow there. The first two investment properties, tied those up, two loans into one, right? Combine them into one. And it's just a snowball effect here and here and here. So now what we're doing is we're taking a property that we bought 2 years ago, and it was nothing but land, right? So it was truly ag. And we're actually, permits just got issued on Friday of last week. So to break ground, now we're leveraging a construction loan to build a multi-unit property on this property. And when it's done, and I can get into that too, but when it's done, we're going to fix that up into just 1 30-year fix. But at the time, they're going to build a multi-million-dollar multi-family property, all leveraged from that parcel. Okay, the loan, construction financing, there's going to be an interest reserve, which an interest reserve is basically a lump sum of funds, like an escrow account, that cover your monthly payment for the duration of construction. So they're going to build this multi-unit. Their payments are actually financed through the loan. And again, they're not coming out of pocket with anything. They're going to have a multi-million-dollar property, multi-unit, multi-million, multi-unit, and we're going to rent that out long-term. They're going to have, I think the numbers worked out to 1.5 to 1.8 million of net equity once it's all said and done, where it's sitting there, not being touched now after we fix it up until they want to buy something else. And so again, it doesn't happen overnight, but financially structuring it the right way, it really is. We've gone from 500,000 to 13.5 million as of Tuesday, and it's about to get to 15 million in about 60 to 90 days, at least, maybe longer, but through the end of the year, we'll get there.
Wow, that's an incredible testimony. I mean, they went from 500,000 to 13 million in 10 years. You said a couple things that were pretty interesting to me. I didn't know that you could package up two different mortgages and put it together and make it one. How does that work?
Yeah, so a couple different ways. Obviously, if you have your primary mortgage or your first lien, okay, whether it's a HELOC or a second or private money second, something with a second lien on there, when the time is right, when it makes sense financially, okay, let's say the second was at 10.5%, hypothetically, right, on a HELOC maybe a year ago, 2 years ago, right, and their first was at 5%. Mathematically speaking, if I did like a blended average, you're like 7.5, almost 8% combined of interest you're paying, right, between your money. Well, even if rates right now are at 6%, if I fix that up into one on 6%, combine the two into one new loan, yes, you're getting out of your 5% rate, but you're also eliminating a 10.5, 11% rate. So your total interest spend is about 1.5% to 2% lower than you are currently paying right now. Now, personal disciplines come in. If you were personally disciplined and took that savings, you could apply it towards principal, right? Pay down that loan even faster, accelerating your equity gain. You could take that savings and go put it into a CD, an ETF, stocks, whatever you wish of your investment choice, and make money on your money. And at the same time, you're lowering that payment down where now that rental, maybe it was just covering the one-to-one, right? Let's say it's $5,000 a month and rent was $5,000, right? You're not bringing in cash flow from it. you're still gaining equity. You're still net appreciating equity and net worth. Well, now if that payment all in is 4,500, they got $500 more a month in passive income coming in just from that simple little structure. The last thing I'll say on that is that, a lot of individuals or families, they get jaded by the fact of, oh, I don't want to pay points. I don't want to do this. I'm not necessarily saying you should pay points ever, but if something makes sense and you're looking at it from a return, okay, a no point loan may have been at 7% today. And if you paid a half of a percent point, maybe it's 6 3/8. Well, you're fixing that up, that same math and ideology. Well, okay, that's worth it. Tax write off, right? This and that's not out of pocket. You're going to recoup those funds in literally, less than 12 months. That's a smart investment. It's a smart. So I think the whole principle behind this thing is it started with a roof over their head as a primary residence with the mindset that is actually an investment tool for long-term wealth. And so if we structure things, review things annually the right way, you really can generate a substantial amount of wealth. I mean, Eric, there's a stat out there. I'm a numbers guy, right? Everything I do is by numbers. 1 + 1's got to equal 2. So there's a stat out there over the past 60 years, the average appreciation of real estate through the '08 crash, through the dot-com bubble, through the '90s crash, you name it, right? Through all these things, is about 6.2% annually. So $1 million property, you're making $62,000 a year on average just in appreciation. Now, if you get creative and start doing those things that I'm talking about, right, you can accelerate that. And if you ask somebody, how hard is it to save up, especially in this state, say $62,000 a year? You own a house, maybe you have kids, maybe you don't, but you have a family, you have expenses, a car, you have this and that. It's real hard to save up $62,000 in that bank account. I mean, I don't care how much you make. It's hard, right? Taxes,
Yeah.
everything, it eats away. With real estate, it's like this hidden gem that people know about, but they don't know about. Because again, we get into this of, hey, I need to buy my first house. Fantastic. I love it. I think it's been a little too commoditized. I think it is a big deal to buy your first house. But now let's take that first house and generate with it. Let's go, right? Over a 5-year average, you're talking a couple $100,000 you're just making on that piece of real estate. So I just
Right.
think it's kind of put to everybody's back of their mind. And if you kind of put it to the forefront from day one, yes, you're buying your primary residence to live. I think it's better than renting. But there's also this, and this. This is how you grow your family. Go back to that same analogy. Now I have 2 kids and a wife or spouse or husband, right? And I bought this house. We need a bigger house. Been really hard to save up. Do I sell my house, pay capital gains, pay 6% in total fees between, amazing agents like yourself, because that's what it costs, right? That's not sugarcoating it. That is cost, because there is a job involved, a service involved that is worth the funds, right? Well, what if we could save that property, rent it out, pull enough equity to buy your next place that now fits your family's needs, and at the same time, you're not quitting your job because you're renting out your first property, right? But over 30 years, somebody else is paying it down, and you took the funds out, untaxable, to buy your next house that now fits your family size. No capital gains tax. I'm sorry, Eric, no realtor fees on this one, but
Mhm.
on the purchase, right? Now we're literally helping families build over and over and over. So you could view it as a stepping stone, right? Step 1, 2, 3, and 4. That path just gets a little longer, but the stones are bigger, right? So you
Right.
start compounding things.
So what would you say to someone that's listening to you and saying, well, it must be nice for them. They started in 2015. Here we are, 2025. Rates are higher, prices are higher. It's impossible. What if someone had a limiting it belief, like it's impossible to do that or replicate that again? How would you advise them? And is it still possible?
I think that's a great question. So here's my advice. I would say that if you had to go back on FOMO, right? You missed out on the 2020 bubble with the low rates, right? Well, at that time, you were going 6 figures over asking because it was so competitive. Okay. Same concept applies right now today. So real estate again, on average, 6.2%. That's not stopping. Okay. We could go all the way to basic economics 101. So if I'm having a conversation with a first time home buyer, one, let's just go over truly economics because it is important, right? There's a supply issue, especially in California. There's no more land to build. And if they are building it, the cost of goods to build expensive. Everything's going to continue to go up. So let's just pause on the topic of I'm going to wait for things to go down where now I can afford it. Honestly, it's just not going to happen. And it's
The
nice.
only way that that would happen is if there's a supply glut.
Yep. And builders are, I want to say we're 2 million units, 2 million doors under demand right now. It would take
Nationally, right?
30 years for builders to accomplish that.
Wow.
Like legitimate stats there. There's
Yeah.
something crazy like that. So yes, to your point, unless I don't even want to say it, something dramatic happened, which I can't even foresee, it's not going to go down, right? So you're still going to have that steady appreciation. Now, what happens if rates go down? All the buyers with that same mindset are going to come off the sidelines.
Right.
If rates
Exactly.
went into the fours today,
Yeah.
the hundreds of thousands of people across the country that have been waiting, they're all coming out. And guess what? That $1 million property, you're now going to spend 1-1 and go 100,000 over because you got 30 people. So it's the sales cycle that's going to come back. So right off the bat, if we eliminate myths of like that, that would be my first step. Number 2 of affordability. Yes, rates are elevated, but this is not a high rate. We just got accustomed to extremely low, unsustainable rates, right? So 5-6%, we just said 6.2% average appreciation, right? These are not bad rates. Now, there is a personal conversation that I would have too here and go, what is your comfort level? What are you paying right now in rent? Because I know a single family right down the street from my house is going for $5,000 a month when I would never think that in a million years, right? Well, okay, a mortgage is $5,500 a month for that house. $500, call it $1,000 more a month. The benefits of home ownership, tax deductions, number 1, right? Every time you're making a payment monthly, interest that you're paying is tax deductible, right? Number 2, it really is cliche to say, but you are paying for your own asset. You're paying down a loan on an asset that's still appreciating value. Well, Troy, how do I afford it monthly? Well, let's go through a budget together is always my number 1. I really do go through budgets with all my clients. I think it's vital. Let's figure out your sweet spot and back into it. Do we need to have 10% down, 15% down to make this work? Can we go with a property that you love? And I'm just going to use $1 million because it's round figures, right? It's $1 million. But if I could get your rate 0.75% lower, it fits our budget. How do we get there? Well, why don't we go $1,010,000 on our offer, get a $10,000 seller credit, use that credit from the seller. We're going to buy down that rate to where now it's comfortable for you. There's a lot of ways to skin the cat that aren't really talked about. And from a seller's perspective, they asked for $1 million. They got their $1 million. Just because we went up 10 and got a credit, it's a movement of money on paper. But again, it's a strategy, a seller buy down strategy is what we call it. It's been huge for us in this market environment. Even going above what they're asking, they're still seeing the same net. Now the buyers are getting that credit and applying it to actually make their payment work for them. Well, what if I just put $10,000 more down? Here's the biggest myth and why I went from like the beginning of this of the lowest down possible. For every $1,000 you spend on a down payment or put down on a house, it's about $5.50 in payment. It's going to fluctuate depending on what rates are. So for $10,000 more, you're going to save $55 a month. I don't know about you, Eric, but I'd much rather have $10,000 in my bank, spend $55 more a month, and that $10,000 I saved in my bank, I have reserves for, I don't know, 50, 60 months. If I ever got into a pinch, cash is king. So again, it's not always, if I put down more, I'm going to save more. It's actually really indicative of the rates and how we structure it that way. And there's ways, like I was saying with the seller buy down, where you may feel pinched out, but there's ways to go about this. You're not over leveraging yourself. $10,000, you're going to make that up in 1 month, right? On property value. Take that credit, buy it down. The other thing that I see a lot of, Eric, is people have side hustles. If you see behind me, I'm a hobby guy, right? I like sports cards. I collect sports cards. I sell, trade, I flip them. I love it. Well, I actually started a thing called cardboard to contracts. As weird as that sounds, like cardboard. 2 contracts. It's a hobby. It's on the side where I could go and save up a down payment just from that stuff. And if I need the extra income, I can use one of my alternate doc income qualifying programs. Now on paper, I qualify for this loan. There's so many ways that just aren't talked about out there. It's very, I don't know if it's kosher, but it's very black and white, right? There's 3 flavors: vanilla, chocolate, strawberry. Well, I'm the 31 flavors. There's 31 flavors for borrowers right now to get into a house affordable. They just don't know about it. It's just not talked about. You could rent out a room if you needed to. You could build an ADU and rent that out and supplement the mortgage payment. Just questions that aren't being asked. So to get back to your question, I think there's so many different ways that you could go about that. I think the biggest thing though is the longer you wait, the harder it's actually going to become. I really believe that. And if rates keep dropping down, you're actually putting yourself in a worse position because again, competition coming off the sidelines is going to be greater. And so if you could find a way with trusted advisor, with your agent, somebody like Erik, that we're working through all these scenarios, and you could get into a property, and even if you're at 6.5%, in the next 12 to 18 months, there's a good probability that those will get lower, right? Well, when they get down into the, let's say the 5s, we just talked about, they go down, people are coming off, values are going up. Because guess what happened to all your appreciation? Skyrocketed. You go and refinance, now you have a lower rate on natural equity gain and appreciation. Drop the rate down, boom. You just saved a ton of money. You made a bunch of money technically on paper, just like stocks, right? You can have a portfolio, but until you sell it, it's just paper money, right?
Mm-hmm.
At the end of the day, if you structure real estate the right way and use the rules, laws that have been written, you can make substantial family wealth for the future. Let's put it that way.
Yeah. And I'm glad we started off with the discussion of the story of your clients that actually did that through your guidance. I think that through today's conversation, we've really understood that you are a wealth of information. So I think we should probably drill down on some of these specific loan types and strategies. For example, maybe next time we talk about tax advantages.
Yep.
And then, yeah, I think it'd be tremendously valuable. So thank you for your time today. How, if someone wanted to talk about how to grow their wealth through real estate, how do they get in contact with you?
Easiest way in reality, Erik, is call me or text me directly on my cell phone. 805-338-8801. If you are on social media, on Instagram, my handle, I guess, is, I don't know if that's still the cool thing the kids call it these days. I feel very old in the social media space, but I am 007 of lending, 007 of lending. That's the easiest way. And then email, if you prefer that, it's my first name, Troy W @prmg.net. So lots of different ways. And then the most important, I would say, call Erik. Honestly, we've worked very well together. We're on the same mindset. We've done great things for our clients, and it's a team effort in this space. So I think if we get in contact with Erik and myself, we put together a game plan, unlimited possibilities for the future.
Yeah, success is inevitable.
Absolutely.
All right, Troy, thank you so much for your time. I appreciate it and look forward to drilling down on some more of these subjects.
Absolutely. Thanks, brother. Appreciate it. Have a
All right,
great one.
take care. Bye-bye.